Hello and welcome to the paid weekly recap for the week ending March 13th, 2026. I'm Keith Harwood, CIO of Yellow Tunnel, and also pictured as Vlad Karpel, the CEO and founder of Yellow Tunnel and the creator of the artificial intelligence behind the paid system. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Yellow Tunnel and myself are not investment advisors and not registered with the SEC nor FINRA. The information in this presentation is for education and information purposes only and should not be considered trading advice. And finally, myself and/or the team at Yellow Tunnel may have a financial interest in the securities presented in the trade ideas. I also urge you to read the characteristics and risks of standardized options available at the highlighted link. And if you need more time with the disclosures, please go ahead and pause the video here. Now on to the recap for this past week. We had a very large run up so far in the 10-year yield, both last week and then this past week as well. The 10-year yield was breaching 4%. It looked like we were going to have a lower interest rate environment, potentially signaling some lowering of interest rates from the Fed that could help spur economic growth. And now we've seen a rising tide in the interest rates with lower economic growth, and it can't be battled with the Fed at this point. Due to the geopolitical risk and the tensions going on in the Middle East with Iran, we have started to once again start talking stagflation, where there is going to be an inflationary market. You've seen it in oil prices that reduces the odds that the Fed can lower interest rates. Traditionally, when we see inflation, the Fed looks to raise interest rates. Can't raise interest rates if we have low economic growth. We can't lower interest rates if we have inflation, and the Fed is stuck. And that can create a lot of fear and concern for the broad market. And we're seeing that in stocks. The S&P 500 closing the week on multi-month lows. Excuse me. These are the lowest levels we've seen since November. We're testing the 200-day moving average. This is a big level. From the moving average followers, below the 200-day moving average indicates that the long-term bull trend has come to an end. And we haven't really breached that in about a year since we had the tariff war with China. So we went from tariff war concerns causing those panic behavior, panic reactions a year ago. This year we've got the missiles and everything else going on in Iran, causing a similar reaction to the market, this time, an air and land war and sea. Now, all of this has caused spikes in oil prices. It's caused a lot of concern about economic disruption. And where we've seen a little bit less of a reaction, somewhat interestingly, is tech. So tech traditionally, when we see these higher interest rates and we see a lot of risk-off behavior, tends to be the laggard or tends to be the leader to the downside. Instead, this time, tech hadn't been as strongly allocated to. We've seen for months rotation out of tech and into other sectors, whether it would be industrials or financials at a certain point, healthcare. And so that lack of major long positioning in tech seems to be helping hold it up. Now, that said, it is also testing the 200-day moving average. It is testing recent lows. It is at risk of a big fall here. If this market cannot bounce off of this inflection point like it has in the past, we may see some serious panic this week. But if it does, resistance above for tech is around that 100-day moving average, right around the 615 level. Back in the S&P, the resistance is back at the recent all-time highs. But frankly, I expect that if the S&P bounces back, it goes to the middle of the range. Tech may bounce back to the 100-day moving average. Small caps may bounce back towards that 260, 265 range. And as you can see over the last couple of weeks, since the geopolitical tensions have risen in Iran, small caps have been the biggest laggard here. Although they did not make new lows for the week on Friday, it's been a more significant pullback here, particularly when compared to tech. So overall, we've got a weakening market conditions, a lot of concern here. We also have an elevated VIX, approaching 30 and somewhat stable here above this 20 level. Now, usually I see that the AI signals tend to be strongest with the VIX under 20. Recently, I've actually found that the AI signals are still continuing to be strong. So a bit reluctant to look at a new paid trade given the elevated VIX, but overall, if these signals remain strong in spite of the geopolitical risk, in spite of the fundamental inputs, and in spite of the elevated VIX here, we may see a new trade this week. I'm going to be watching that closely. We'll also be talking about other market conditions and ideas through the live trading room. Please be sure to join us. We continue to find some opportunities here and there. It's maybe a bit more selective as needed, trading certain ranges, focusing on sectors that may be outside of our normal wheelhouse recently. So the market wheelhouse recently has been tech. That had been the focus. We're moving away from tech. We're looking at stocks in the fertilizer sector or in the energy sector and seeing good opportunities still there. So being flexible and dynamically updating the sectors that you're looking at is always key. And this is a great spot for the AI to help with that, to help identify those sectors that do still have upside, as well as those sectors that have potential for significant downside. All right. Make sure you reach out to us if you have any questions. Either join us in that live trading room or hit us up via email. I'm Keith at yellowtunnel.com and Vlad is Vlad at yellowtunnel.com. Thanks again, everyone. Should be an interesting week ahead. Once again, we'll see how the market can handle this inflection point near recent lows or at recent lows.